Welcome back. With the country facing severe infrastructure constraints and slow pace of implementation of mega projects, the Economic Survey called for putting in place new models of financing the infra sector to meet the funding requirement of $1 trillion US. In view of the massive requirements of funds, all efforts need to be made to attract big-ticket long-term investors such as strategic investors, private equity funds, pension funds, and sovereign funds. There is also the need for introducing more innovative schemes to attract large-scale investment into infrastructure and strengthening domestic financial institutions and development of a long-term bonds market. Here is a detailed report.
During the 10th plan, the share of private investments to total investment was roughly 20%, which was at 30% in 11th plan. While the government is targeting an infrastructure spend of $1 trillion in the 12th plan, it is heavily depending on investments by private sources to the tune of nearly 50% to massive $500 billion. While the global economic scenario remains uncertain, India will enjoy the advantage of being the few safe global investment destinations providing reasonably good growth and returns on investment. Nevertheless, India has some impediments and unnecessary formalities that need to be straightened, or else the risk of uncertainty will definitely make private investors hesitant to participate in infrastructure, thereby jeopardizing the government's 12th plan infrastructure investment target.
Social regulatory compliances, slowdown in the awarding of the contracts, climatic conditions, political interferences, and also the governmental department have the right of way for the access of the projects and the interferences of the NGOs having display. These all complexes have resulted in a cumbersome process in the development of the construction industry.
To reduce the pressure on public sector funding, there is a need to create a conducive environment for private sector participation with a transparent and credible regulatory mechanism for financing the infrastructure projects.
Some hard decisions will have to be taken post the budget to ensure that the domestic drivers of growth in the current macroeconomic environment boost sentiment and boost progress.
Traditionally, infrastructure projects have been funded through debt-equity ratio of 70:30 due to their highly capital-intensive nature. Major chunk of the debt is raised from domestic commercial banks. The weak corporate bond market impedes the ability of financiers to raise long tenure funds, while the huge amounts of long-term capital lying with insurance and pension funds rarely pours into the infrastructure sector, mainly on account of various restrictions.
Private participation is in the equity has to be taken up, which has been to have to be taken up in the mature debt ratio, which the government is looking at that how to get into the private equity in place and having the complete funding in the projects which can take a next leap. And we augment that thing what we have envisaged in our 12th five-year plan.
Private sector feels that governmental strong initiatives are needed to encourage private participation. Risks should be distributed among public and private sector. Taxes should be made minimum as these get passed on to the government at a premium, and interest rates of loans for these infrastructural projects should be reduced.
The tax reforms that have been pending, but we see now movement forward. I mean, if you look at the DTC, at least some parts of the DTC have been incorporated, whether it's a negative service list or even raising of duties. And I shouldn't say raising of duties is positive, but if we're going to settle for a rate of 12%, then there's a movement in that direction. GST, again, a roadmap is coming in some way, but it could have been harder.
Other than policy inadequacies and naturally uncertain risks, depending on the infrastructure segment, there are various risks attached to a project like land acquisition local problems, public resistance, and hurdles to obtain various statutory clearances.
Every PPP project is not interesting, I mean, from the developer's point of view. So the government has to give SOPs, and they have been doing that in terms of whether it's an annuity project or it's sometimes they ask you what grant they can give you, viability funding, etc., etc. So I think they're on the right track on that. But what I think the government will have and the regulators will have to do is to sort out the land issues before they even tender out projects. Because what kills the business is you think that you're going to bid a job and complete it in 2 years or 3 years. But when you go on the ground and you stay on for 5 years or 6 years, it's not benefiting anybody. I mean, and it is really difficult for the companies to be able to sustain that kind of a loss.
Execution has been an area where I think a lot of work we have to do as a country, and all of us have to do. A lot of coordination with state levels, at the state level, because execution is done at the state level, so there has to be far more linkage, which we found perhaps not very apparent.
Historically, infrastructure services in India have been provided by the central and state governments who finance such projects and provided it without any charge or at a low charge to citizens. The return on investment on such projects, when being taken up there through private participation, needs to be attractive to lure private participant.
While infrastructure is a rapidly growing sector in India, its future development is dependent upon the formulation and effective implementation of initiatives and policies that facilitate and encourage private sector investment in infrastructure. Many of these programs and policies are evolving, and their success will depend on whether they are designed to properly address the issue faced and are effectively implemented. These programs will need continued support from stable and experienced regulatory regimes that not only stimulate and encourage the continued movement of private capital into infrastructure development, but also lead to increased competition, appropriate allocation of risk, transparency, effective dispute resolution, and more efficient and cost-effective services to the end consumers. That's all we have in today's episode of Power News. You could send us your suggestions and views at powernews@znetwork.com or call us on 011-405-60701. Do join us next week for more news and updates. Till then, goodbye and take care.